Today, we're diving into one of the most fascinating and, let's be honest, shadowy corners of the business world: creative accounting. It's this sophisticated art of making a company's finances look a whole lot better than they really are, usually by dancing right on the very edge of the law.
So let's just jump right in with a pretty provocative question. Can a company actually lie on its financial reports without, technically breaking the law? It sounds completely impossible, right? But the answer is a very complicated yes, and it really gets to the heart of what this is all about.
So, how on earth is this even possible, legally speaking? Well, it all comes down to this really crucial distinction that lawyers and accountants absolutely love to debate: the difference between the letter of the law and the spirit of the law. And this slide really breaks it down perfectly. On one side, you've got fraud. That's simple, right? Making stuff up, faking sales, it's totally legal, end of story. But creative accounting, that lives in the gray area. It doesn't break the rules, it just bends them. It's the art of following the exact wording of the law while completely ignoring what the law is supposed to do, which is, present a true and fair picture of a company's financial health.
Okay, so that begs the next logical question, right? Why would any company even risk this? What are the pressures that are so powerful they drive executives to, well, cook the books?
It really all comes down to pressure, just immense pressure. You've got Wall Street breathing down your neck to meet or beat earnings forecasts every single quarter. And if you miss by even a penny, your stock could absolutely tank. And then, of course, there's the personal incentive. Executive bonuses are almost always tied directly to these numbers. And finally, a healthy-looking balance sheet helps you get better loans and keeps you from breaking the rules on any debt you already have. It is a very high-stakes game.
So, how do they actually pull it off? Let's go ahead and open up the Creative Accountant's Secret Toolkit and take a look at a couple of the most classic techniques they use to massage those financial results.
First up, we've got a classic called channel stuffing. So picture this. It's the last week of the quarter and you are just short of your sales target. So what do? You call up your distributors, you offer them a massive discount to buy way more product than they could ever sell. You ship it all out, you book all of that revenue right now, and boom, your numbers look fantastic. The problem? You just stole sales from your own future, and you know deep down a ton of that product is coming right back to you as returns next quarter. Here's another really clever trick: capitalizing costs. So normally, a regular expense, let's say routine maintenance, it immediately reduces your profit for the year. But with a little creative accounting, you can reclassify that expense as a long-term investment or an asset. And by doing that, you just magically wipe the cost from this year's expense sheet, which instantly boosts your profit. The cost then gets spread out really slowly over many, many years. WorldCom famously used this trick, turning billions in regular operating costs into assets to create this complete fantasy of profitability. Now, when you take these kinds of techniques and push them to the absolute extreme, you get one of the most infamous corporate scandals in all of history. So let's open up the Enron playbook. The scale of Enron's deception was just breathtaking. We are talking about billions, with a B, of dollars in debt that were just invisible on their main financial statements. So how in the world did they hide something that big? Well, their main tool was something called a special purpose entity, or an SPE. Enron created literally hundreds of these legally separate little companies. And then they would move massive amounts of debt and super risky assets off their own balance sheet and onto the books of these SPEs. Because of a specific accounting loophole back then, if an outside investor owned just 3% of that little company, Enron didn't have to include any of its finances in their own reports. It was the ultimate magic trick, using these secret legal vaults to make billions in debt just vanish from view. But here's the thing about a company that's built on financial illusions: it can't last forever. Eventually, that house of cards has to come tumbling down. And when it fell, oh man, it fell fast. Just look at this timeline. Once the SEC started poking around in 2001, the collapse of trust was immediate and it was total. The stock price just evaporated, the company went bankrupt. And the scandal was so massive, it even took down its huge accounting firm, Arthur Andersen, which shattered public faith in the entire auditing industry. The fallout from Enron and WorldCom was so bad, it triggered a regulatory earthquake. The U.S. Congress passed the Sarbanes-Oxley Act. You might have heard of it as SOX.
This was a landmark law that made it much, much harder to play these games. It forced CEOs and CFOs to personally sign off on their company's financials, under the threat of actual jail time, and it created strict new rules to make sure auditors were truly independent from the companies they were supposed to be watching.
But, the arms race between the people who make the rules and the people who try to bend them, it never really stops. So for our final section, let's look at the new frontiers where creative accounting is evolving right now, today.
And these new frontiers are really complex and kind of murky. With the rise of ESG, that's environmental, social, and governance investing, we now have this term greenwashing, where companies can creatively report their environmental impact to look a lot better than they really are. And in our tech economy, how do you even fairly value intangible things like brand reputation or a piece of software? It's really subjective. And then there's AI, a total double-edged sword that could help auditors find fraud or help financial engineers design even more perfect, undetectable schemes. Which brings us to our final, lingering question. As technology gets smarter and smarter, are we finally going to be able to make sure that financial statements actually reflect reality? Or will that very same technology just give creative accountants the tools to build illusions that are more convincing and, frankly, more dangerous than ever before?